quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders don't fail because trading is impossible. They fail because they keep making the same mistakes over and over again, often without even realizing it. And what makes this more dangerous is that these mistakes are not obvious. They don't feel like mistakes in the moment. They feel like logic. They feel like instinct. They feel like this time is different. This is where most traders get it wrong. They assume that success in trading comes from finding better entries, better strategies, or better indicators. But the reality is far more uncomfortable. The biggest obstacle to profitability is not the market, it is behavior. In this video, you're going to go through the most common, most destructive trading mistakes that keep traders stuck for years. Not surface level mistakes, but the real underlying errors in thinking, decision making, and execution. And more importantly, you're going to understand exactly how to fix them in a structured, professional way. Because identifying mistakes is only half the process. The real transformation comes from correcting them with discipline and consistency. That's what separates amateurs from professionals. But here's something critical to understand from the beginning. These mistakes are not random. They follow patterns. Almost every struggling trader goes through the same cycle. Overconfidence, overtrading, emotional decisions, inconsistency, and eventually frustration. Then they reset, promise to do better, and repeat the cycle again. If that sounds familiar, that's not a coincidence. That's the natural path of an unstructured trading approach. By the end of this, you will see those patterns clearly. You'll understand why they happen, how they reinforce each other, and most importantly, how to break out of them permanently. Because once you eliminate the biggest mistakes, something powerful happens. Trading becomes simpler, clearer, more controlled, and that's where real progress begins. Let's start by reframing how you should think about mistakes in trading. Most people treat mistakes as isolated events. A bad trade here, a loss there, a moment of poor judgment. But that perspective is flawed. Mistakes in trading are rarely isolated. They are systemic. They come from deeper issues in your process, your mindset, and your structure. For example, taking a bad trade is not the real mistake. The real mistake is not having a defined system that filters out low-quality trades in the first place. Closing a trade too early is not the real mistake. The real mistake is not trusting your plan or not having one that you fully understand. This is why simply trying to be more disciplined doesn't work. Discipline without structure is fragile. It breaks under pressure. Professional traders don't rely on willpower. They rely on systems. They design their process in a way that prevents mistakes from happening in the first place. Now, this is critical. The goal is not to become perfect. The goal is to become consistent. And consistency comes from removing the biggest sources of error in your decision-making process. Throughout this video, you'll notice a pattern. Every mistake we discuss will have a deeper cause and a structured solution. That solution will not be motivational. It will be practical. It will be something you can implement directly into your trading process. Because trading improvement is not about trying harder, it's about thinking better. And once you shift from emotional reactions to structured thinking, everything starts to change. The first major mistake, and arguably the most common, is overtrading. Overtrading is not just taking too many trades. It's taking trades without a clear edge. It's forcing opportunities when none exist. It's trading out of boredom, frustration, or the need to feel active. This is where most traders lose control. They equate activity with progress. They feel that if they are not trading, they are missing out. But in reality, the opposite is true. The more you trade without a clear edge, the more you dilute your performance. Professional trading is selective, it is patient, it is based on waiting for high quality opportunities, not chasing every movement in the market. Now here's the deeper issue behind overtrading. It's not just impatience, it's a lack of defined criteria. If you don't have a clear system that tells you exactly when to trade and when not to trade, you will default to impulse. And impulse leads to inconsistency. So how do you fix this? You introduce strict filtering. You define your setups with precision. You create rules that must be met before any trade is taken. This is critical. You don't ask, should I take this trade? You ask, does this trade meet my predefined criteria? That small shift removes emotion from the decision. It turns trading into a process rather than a reaction. And once you implement that structure, something powerful happens. Your trading frequency decreases, but your quality increases. That's the first step towards professionalism. The second major mistake is inconsistent risk management. This is where traders undermine themselves without even realizing it. They might have a good strategy, they might even have a decent win rate, but their risk is inconsistent. One trade risks 1%, another risks 3%, another is left open without a defined stop. Over time, this creates chaos in the equity curve. Now this is critical. In trading, risk is the only thing you can truly control. You cannot control outcomes, but you can control exposure. When risk is inconsistent, performance becomes unpredictable. Even a profitable strategy can fail if risk is poorly managed. The deeper issue here is emotional interference. Traders increase risk after losses to recover faster, or after wins due to overconfidence. Both are destructive. Professional traders do the opposite. They standardize risk. Every trade carries a predefined, consistent level of exposure. This creates stability. It allows the edge to play out over time without being distorted by emotional decisions. So how do you fix this? You define a fixed risk model. For example, risking a consistent percentage of capital per trade. You apply it without exception. This is not optional. It is non-negotiable. Because once risk is controlled, something changes. Losses become manageable, drawdowns become predictable, and most importantly, you stay in the game long enough for your edge to work, and staying in the game is everything. The third major mistake is strategy hopping. This is one of the biggest reasons traders never achieve consistency. They try one approach, take a few losses, lose confidence, and immediately move to something else. Then the cycle repeats. Now this is where most traders get trapped. They believe the problem is the strategy, but in most cases the problem is not the strategy, it's the lack of consistency in execution. No strategy works if it is not applied consistently over a meaningful sample of trades. This is critical. You cannot evaluate a strategy based on 5 trades or even 10. You need a structured data set. You need repetition. Professional traders understand this. They commit to a system, they test it, they refine it, and they execute it with discipline over time. The deeper issue behind strategy hopping is discomfort with uncertainty. Traders expect immediate results. When they don't get them, they assume something is wrong. But trading does not work like that. Even a strong edge will experience losing streaks. That is part of the process. So how do you fix this? You commit to one structured approach, you define your rules clearly, and you track your performance over a large sample size. You replace emotional judgment with data-driven evaluation, because once you do that, something shifts. You stop reacting to short-term outcomes and you start thinking in probabilities. And that is the moment you begin to think like a professional trader. The fourth major mistake is trading without a defined edge. This is more common than most traders realize. Many believe they have a strategy, But in reality, what they have is a collection of ideas, opinions, or loosely defined patterns. There is no measurable advantage, no repeatable logic, no statistical foundation. Now this is critical. An edge is not a feeling, it is not intuition, it is a repeatable pattern that produces a positive outcome over time. Without that, trading becomes random. This is where most traders get it wrong. They enter trades because something looks good or feels right. But without a structured edge, those decisions are inconsistent by definition. The deeper issue here is a lack of validation. Traders skip the process of testing and go straight to execution. They assume something works without proving it. Professional traders do the opposite. They define their edge clearly. They understand exactly why it should work. They test it across different conditions, and only then do they commit capital. So how do you fix this? You move from assumption to evidence. You define your setup in precise terms. You document the conditions required for entry, the logic behind it, and the expected outcome. Then you test it, not emotionally, but systematically, because once you know you have an edge, something powerful happens. You stop questioning every trade, you stop second guessing yourself, you execute with clarity. And clarity is what removes hesitation and inconsistency from your trading. The fifth major mistake is emotional decision making. Now, this is often misunderstood. Most traders think emotions are the problem, but emotions are natural. They will always be present. The real problem is allowing emotions to dictate decisions. This is where most traders lose control. Fear causes them to exit too early. Greed causes them to hold too long. Frustration leads to revenge trading. And all of this happens in the moment, often without conscious awareness. Now, this is critical. You cannot eliminate emotion, but you can design a process that prevents emotion from influencing your actions. Professional traders do not rely on how they feel. They rely on predefined rules. They follow a process that is executed the same way, regardless of emotional state. The deeper issue here is a lack of structure. When decisions are not predefined, the mind fills the gap with emotion. So how do you fix this? You shift decision making from real-time to pre-planned. You define your entries, exits, and risk parameters before the trade is placed. This removes the need to decide in the moment, because once the trade is live, your job is not to think, it is to execute the plan. And when you operate like that, something changes. Emotions lose their power. They may still be there, but they no longer control your behavior. That is the difference between reactive trading and professional execution. The sixth major mistake is lack of patience. This is one of the most underestimated challenges in trading, not because traders don't understand it, but because they consistently underestimate its impact. Patience in trading is not just about waiting. It's about waiting with discipline, waiting with intent, waiting for the right conditions, not just any conditions. This is where most traders get it wrong. They see movement and feel compelled to act. They interpret activity as opportunity, but in reality, most market conditions are not favorable. Most of the time, the correct decision is to do nothing. Now, this is critical. The ability to not trade is just as important as the ability to trade. The deeper issue behind impatience is the need for stimulation. Traders become uncomfortable with inactivity. They feel like they should be doing something. But professional trading is not about constant action. It is about selective execution. So how do you fix this? You redefine what productivity means in trading. Productivity is not taking trades. It is following your process. If your process says wait, then waiting is productive. You also create strict criteria for entry, conditions that must be met before a trade is even considered. Because once you do that, something changes. You stop chasing the market. You let the market come to you, and that shift alone can dramatically improve your results. The seventh major mistake is poor trade management. This is where many traders give back profits or turn winning trades into losses. Not because the idea was wrong, but because the execution after entry was inconsistent. Now, this is critical. A trade does not end at entry. In many ways, that's where the real work begins. Poor trade management shows up in different ways: moving stop losses emotionally, closing trades too early, letting losses run while cutting winners short. This creates an imbalance. Even if the entries are good, the overall performance suffers. The deeper issue here is uncertainty. Traders are unsure of what to do once the trade is live. They start reacting to every fluctuation, every movement, every emotion. Professional traders eliminate this uncertainty by defining trade management rules in advance. They know exactly where they will exit if the trade goes against them. They know how they will manage profits. They know when they will take partials or let the trade run. There is no improvisation. So how do you fix this? You define your exit strategy before entering the trade, not after, not during. Before, you remove discretion and replace it with structure, because once trade management becomes consistent, something powerful happens. Your results become more stable, your performance becomes more predictable, and predictability is what allows you to scale and grow as a trader. The eighth major mistake is focusing on short-term outcomes. This is one of the most damaging mindsets in trading. Judging success or failure based on a single trade or a small number of trades. Now, this is critical. Trading is a probability game. No single trade matters in isolation. What matters is the outcome over a large sample size. This is where most traders get it wrong. They win a trade and feel confident. They lose a trade and feel discouraged. Their confidence fluctuates with every outcome. This creates instability. It leads to inconsistent behavior. The deeper issue here is a misunderstanding of how edge works. Even a strong edge will produce losing trades. That is not a flaw. That is part of the system. Professional traders think in distributions. They understand that results play out over time, not in isolated moments. So how do you fix this? You shift your focus from individual trades to overall performance. You track your results over a meaningful sample size. You measure consistency, not outcomes. Because once you make that shift, something changes. Losses stop feeling like failures. Wins stop creating overconfidence. Everything becomes part of a larger process. And when you start thinking like that, you begin to operate with the mindset of a professional trader. The ninth major mistake is the lack of a structured trading plan. Now, this sits at the core of almost every other mistake discussed so far, because without a clear plan, everything becomes reactive. Every decision becomes situational, emotional, and inconsistent. This is where most traders operate without realizing it. They have ideas, they have preferences, but they do not have a defined plan that governs their actions. Now, this is critical. A trading plan is not something vague. It is not, I look for good setups and manage risk. It is a precise framework that defines exactly how you operate in the market. The deeper issue here is avoidance. Creating a trading plan forces clarity. It forces you to define your edge, your risk, your execution, and your behavior. And many traders avoid that because it removes flexibility. But that flexibility is exactly what causes inconsistency. Professional traders operate within strict frameworks. Their plan defines when they trade, what they trade, how they manage risk, and how they review performance. So how do you fix this? You build a structured trading plan that covers every aspect of your process: entry criteria, exit rules, risk management, trade management, and review procedures. and this is important. The plan is not optional, it is your operating system. Because once you have a plan, something changes, decisions become simpler, you are no longer guessing, you are following a defined process. And that is what creates consistency over time. The 10th major mistake is failing to track and review performance. This is where many traders miss one of the most powerful tools available to them. Without tracking, there is no feedback. Without feedback, there is no improvement. This is where most traders get it wrong. They rely on memory. They remember the big wins, the painful losses, but they do not have an objective record of their behavior and results. Now, this is critical. Trading improvement is data driven. You need to see patterns in your performance. You need to identify what works and what doesn't. The deeper issue here is discomfort. Reviewing trades forces you to confront mistakes. It forces accountability, and many traders avoid that. But professional traders embrace it. They track everything. Entries, exits, risk, reasoning, outcomes, and they review it regularly. They are constantly refining their process based on evidence. So how do you fix this? You implement a structured journaling system. Every trade is documented. Every decision is recorded. Then you review it. Not occasionally, but consistently. Because once you start doing this, something powerful happens. Patterns become visible. Weaknesses become clear. Strengths become repeatable. And that is how you evolve from random performance to structured improvement. The 11th major mistake is chasing losses. This is one of the most destructive behaviors in trading. It usually happens after a losing trade or a losing streak. The trader feels the need to recover quickly to get back to where they were. Now, this is critical. The moment you try to recover losses quickly, you lose control of your process. This is where most traders spiral. They increase position size, they take lower quality trades, they abandon their rules, and in doing so they amplify the problem. The deeper issue here is emotional attachment to outcomes. Traders tie their self-worth to their results. A loss feels like failure and they try to fix it immediately. Professional traders think differently. They accept losses as part of the process. They understand that recovery is not about speed, it is about consistency. So how do you fix this? You enforce strict rules after a loss, you maintain the same risk level, you do not increase exposure. You do not deviate from your plan. You treat the next trade exactly the same as the previous one, because once you do that, something changes, losses stop triggering emotional reactions, they become just another data point in your process, and that is how you maintain control during difficult periods. The 12th major mistake is overconfidence after wins. This is the opposite side of chasing losses, but equally dangerous. After a series of winning trades, traders start to feel invincible. They believe they have figured it out. Now, this is critical. Confidence is necessary, but overconfidence is destructive. This is where most traders make mistakes. They increase risk. They loosen their criteria. They start taking trades that do not fully meet their rules. And eventually, the market corrects them, often sharply. The deeper issue here is misattribution. Traders attribute success to skill, when in reality, short-term results can include a significant element of randomness. Professional traders remain grounded. They treat wins and losses the same. They stick to their process regardless of recent performance. So how do you fix this? You standardize behavior. You maintain the same risk, the same criteria, the same execution, regardless of outcomes. You do not let success change your process, because once you do that, something powerful happens. Your performance stabilizes. You avoid large drawdowns caused by emotional overextension. And you build true confidence, not based on outcomes, but based on consistency. The 13th major mistake is ignoring market conditions. This is where traders apply the same approach regardless of what the market is doing. They do not adapt to changes in volatility, liquidity, or overall conditions. Now, this is critical. Markets are not static. They shift between different environments. Trending, ranging, volatile, quiet. This is where most traders get it wrong. They expect their strategy to work the same way in all conditions, but every strategy has strengths and weaknesses. It performs better in certain environments and worse in others. The deeper issue here is a lack of awareness. Traders focus on their setup, but ignore the broader context in which that setup is operating. Professional traders are highly aware of conditions. They understand when their edge is likely to perform well and when it is not. So how do you fix this? You define the conditions under which your strategy works best. You identify the environments where it struggles, and you adjust your participation accordingly. Sometimes that means reducing risk. Sometimes it means not trading at all. Because once you align your strategy with the right conditions, something changes. Your edge becomes more effective, your results become more consistent, and that alignment is what separates reactive traders from professional operators. The 14th major mistake is a lack of consistency in execution. This is where many traders believe they have a good system, but their results don't reflect it. Not because the system is flawed, but because the execution is inconsistent. Now, this is critical. A strategy only works if it is applied the same way, repeatedly, over time. If you change how you execute from trade to trade, you are effectively running a different strategy each time. This is where most traders get it wrong. They follow their rules on one trade, then deviate on the next. They skip valid setups, then take invalid ones. They adjust risk, timing, or exits based on how they feel in the moment. The deeper issue here is a lack of discipline reinforced by a lack of process. Without a structured framework, consistency becomes dependent on mood, focus, and external factors. Professional traders remove that variability. They operate in a repeatable, controlled way. Their execution is consistent because their process is clearly defined and followed without exception. So how do you fix this? You reduce discretion. You define your rules in a way that leaves minimal room for interpretation. You create a checklist and every trade must pass through it. Because once execution becomes consistent, something powerful happens. Your results begin to reflect your actual edge, not your fluctuating behavior, and that is when real progress starts to show. The 15th major mistake is trading without a clear time horizon. This is more subtle but extremely important. Many traders enter trades without fully understanding whether they are taking a short-term position, a medium-term trade, or something longer term. Now, this is critical. Your time horizon defines your expectations. It defines how you manage the trade, how you interpret movement, and how you respond to volatility. This is where most traders get it wrong. They enter a trade with a vague idea, then change their approach as the trade develops. A short-term trade suddenly becomes long-term when it goes into a loss. A long-term idea gets closed early because of short-term noise. The deeper issue here is a lack of clarity. Without a defined time horizon, your decisions become inconsistent and reactive. Professional traders define this before the trade is even placed. They know whether they are looking for a quick move or a sustained trend, and their management aligns with that objective. So how do you fix this? You assign a clear time horizon to every trade. You define how long you expect the idea to play out and what kind of movement you are targeting. Then you align your management with that. Because once you do that, something changes. You stop reacting to every small fluctuation. You stay aligned with the original intent of the trade, and that alignment brings clarity and control to your execution. The 16th major mistake is ignoring transaction costs and practical realities. This is something many traders overlook, especially in the early stages. They focus on entries and exits, but ignore the impact of spreads, commissions, and execution quality. Now, this is critical. Even small costs can compound over time and significantly affect performance. This is where most traders get it wrong. They assume that if a strategy works in theory, it will work in practice. But once costs are applied, the edge may be reduced or even eliminated. The deeper issue here is a lack of realism. Traders operate in an idealized version of the market rather than the actual conditions they are trading in. Professional traders account for this from the beginning. They incorporate costs into their testing and their expectations. They understand how execution affects outcomes. So how do you fix this? You factor in all costs when evaluating your strategy. You consider spreads, commissions, slippage, and execution delays. You ensure that your edge remains valid after these factors are applied. Because once you do that, something changes. Your expectations become realistic. Your performance becomes more aligned with actual results. And that realism is essential for long-term success. The 17th major mistake is trading without a defined routine. This might seem simple, but it has a profound impact on consistency and performance. Without a routine, trading becomes sporadic. Decisions are made without preparation, without structure, and without focus. Now, this is critical. Consistency in trading is not just about what you do during a trade. It is about how you prepare, how you execute, and how you review. This is where most traders get it wrong. They open charts randomly, take trades impulsively, and review performance inconsistently. There is no rhythm to their process. The deeper issue here is a lack of structure outside of trading itself. Without a defined routine, it becomes difficult to maintain discipline and focus. Professional traders operate within a structured daily and weekly routine. They prepare before the market, they execute during defined periods, and they review afterwards. So how do you fix this? You create a consistent routine, a structured approach to preparation, execution, and review, because once you do that, something changes. Trading becomes organized, decisions become more deliberate, performance becomes more consistent, and that structure is what supports long-term improvement. The 18th major mistake is relying on external opinions. This is where traders allow news, social media, or other traders' views to influence their decisions. They lose ownership of their process. Now, this is critical. Every decision in trading must be your own. Not because external information is useless, but because responsibility cannot be outsourced. This is where most traders get it wrong. They see an idea, they hear an opinion, and they act on it without fully understanding the reasoning behind it. The deeper issue here is a lack of confidence in one's own process. Traders look for validation instead of relying on their own framework. Professional traders may be aware of external views, but they filter everything through their own system. If it does not align with their process, they ignore it. So how do you fix this? You build confidence in your own framework. You rely on your analysis, your rules, and your data. You take full responsibility for every decision, because once you do that, something changes. You stop being influenced by noise. You operate with clarity and independence. And that independence is a key characteristic of professional trading. Now, this is where the conversation shifts from identifying mistakes to understanding how professionals actually think about them. Because professional traders do not simply try to avoid mistakes, they build systems that make those mistakes difficult to commit in the first place. This is a completely different approach. Instead of relying on discipline alone, they design constraints. They remove decision points. They reduce complexity. This is critical. Every mistake discussed so far, overtrading, inconsistent risk, emotional decisions, all come from too much freedom in the process, too much room for interpretation. Professional traders operate within clearly defined boundaries. Their process tells them what to do, when to do it, and when to do nothing. The deeper insight here is that consistency is engineered, not hoped for. So instead of asking, how do I stop making mistakes? The better question is, how do I structure my process so these mistakes cannot easily occur? That shift changes everything. It moves you away from reactive behavior and towards controlled execution. And once your process is designed in that way, something powerful happens. Mistakes reduce naturally, not because you are trying harder, but because the system is guiding your behavior. That is how professionals create stability in an inherently uncertain environment. Another key difference in professional thinking is how mistakes are interpreted. Most traders see mistakes as failures, something to be avoided, something that damages confidence, but professionals see mistakes differently. They see them as feedback. Now this is critical. Every mistake contains information. It reveals a weakness in your process, your assumptions, or your execution. This is where most traders get it wrong. They either ignore mistakes or react emotionally to them. They do not analyze them objectively. The deeper issue here is ego. Accepting mistakes requires humility. It requires the ability to detach from outcomes and look at performance analytically. Professional traders build feedback loops. Every mistake is reviewed. Every deviation from the plan is identified, and adjustments are made accordingly. So how do you fix this? You formalize your review process. You don't just note that a mistake happened. You identify why it happened and how it can be prevented. You turn every mistake into an improvement mechanism. Because once you do that, something changes. Mistakes stop being setbacks. They become part of the development process. And that is what allows continuous improvement over time. Professional traders also understand the concept of asymmetry in mistakes. Not all mistakes are equal. Some have minor impact, while others can be catastrophic. Now this is critical. The goal is not to eliminate every small error. The goal is to eliminate the mistakes that cause significant damage. This is where most traders get it wrong. They focus on minor inefficiencies while ignoring the major risks. The deeper issue here is misprioritization. Traders spend time refining entries but ignore risk management. They optimize small details while leaving themselves exposed to large losses. Professional traders focus on downside protection first. They ensure that no single mistake can significantly damage their capital. So how do you fix this? You identify the highest risk mistakes in your process. Over leveraging, removing stop losses, deviating from risk rules. Then you create safeguards around them. Hard limits, strict rules, non-negotiable constraints. Because once you do that, something changes. Your downside becomes controlled. Your survival becomes more likely. And survival is the foundation of long-term success in trading. Another critical insight is how professionals deal with uncertainty. Most traders try to eliminate uncertainty. They look for confirmation, certainty, and perfect conditions. But that does not exist in trading. Now this is critical. Uncertainty is not a problem to solve. It is a condition to operate within. This is where most traders get it wrong. They hesitate, overanalyze, or avoid taking trades because they are waiting for certainty. The deeper issue here is discomfort. Uncertainty creates anxiety, and traders try to remove it by seeking more information or delaying decisions. Professional traders accept uncertainty as part of the process. They do not need to be certain, they need to be consistent. So how do you fix this? You define your edge and trust it. You accept that not every trade will work. You focus on executing your process rather than predicting outcomes. Because once you accept uncertainty, something changes, you stop hesitating, you stop overthinking, you execute with clarity. And that clarity is what allows your edge to play out over time. Finally, professional traders think in terms of systems, not individual actions. This is one of the most important shifts you can make. Instead of focusing on individual trades, they focus on the overall process that produces those trades. Now, this is critical. A single trade is irrelevant. It is the system that matters. This is where most traders get it wrong. They obsess over entries, exits, and individual outcomes. They try to perfect each trade. The deeper issue here is a lack of long-term perspective. Traders focus on immediate results rather than sustained performance. Professional traders design systems that produce consistent results over time. They refine the system, not individual trades. So how do you fix this? You shift your focus. You stop asking, was this a good trade? And start asking, did I follow my system correctly? Because once you make that shift, something powerful happens. Your mindset changes from reactive to structured, and that is the foundation of professional trading. Now it's time to bring everything together into practical application, because understanding mistakes is one thing, but correcting them requires a structured approach that you can actually implement. The first step is awareness. You need to identify which of these mistakes are present in your own trading, not in theory, but in reality. This is critical. You cannot fix what you are not aware of. So you begin by reviewing your recent trades, not just the outcomes, but the decisions behind them. Were they aligned with a defined plan? Was risk consistent? Were entries and exits structured? This is where most traders get it wrong. They look at profit and loss, but ignore behavior. The deeper shift here is moving from outcome-based evaluation to process-based evaluation. Once you identify the key mistakes, you prioritize them. You do not try to fix everything at once. You focus on the highest impact issues first, because trying to change everything simultaneously leads to overwhelm and inconsistency. So instead, you isolate one or two critical mistakes, you bring full attention to them, you track them, you correct them, and once those are improved, you move to the next. This is how real progress is made, not through drastic changes, but through focused incremental improvement. The second step is building safeguards into your process. Now, this is where most traders underestimate what's required. They rely on intention instead of structure. They say they will be more disciplined, but they don't change the system that creates the problem. This is critical. Behavior changes when the environment changes. So instead of relying on willpower, you create constraints. If overtrading is an issue, you limit the number of trades per day or week. If risk inconsistency is a problem, you define a fixed percentage and automate it. If emotional decisions are an issue, you introduce checklists that must be completed before any trade is placed. This is how professionals operate. They don't leave decisions open to interpretation. They build processes that guide behavior. The deeper insight here is that discipline is supported by structure. Without structure, discipline will eventually break. So how do you fix this? You redesign your trading environment. You remove unnecessary decision points. You simplify your process. Because once you do that, something changes. Good behavior becomes easier. Bad behavior becomes harder. And that shift is what creates consistency over time. The third step is creating a feedback loop for continuous improvement. This is where trading becomes a process of refinement rather than repetition. Now, this is critical. Without feedback, mistakes persist. With feedback, they get corrected. So you implement a structured review process. Weekly, not occasionally. You analyze your trades, your decisions, and your adherence to your plan. This is where most traders get it wrong. They review inconsistently or only after losses. The deeper issue here is a lack of commitment to improvement. Professional traders treat review as part of the process, not an optional activity. They use it to identify patterns, refine their system, and improve execution. So how do you fix this? You schedule your reviews, you make them non-negotiable, you ask specific questions. Did I follow my rules? Where did I deviate? What can be improved? Because once you do this consistently, something powerful happens. Your trading evolves, mistakes reduce, execution improves, confidence becomes grounded in evidence, not emotion, and that is how you build long-term consistency. At this point, you can start to see the bigger picture. Trading success is not about finding something new, it is about removing what doesn't work. Most traders spend years searching for better strategies, better indicators, better systems. But the reality is far simpler. The biggest improvements come from eliminating the biggest mistakes. Now this is critical. Every mistake discussed in this video has a direct impact on performance. Overtrading, inconsistent risk, emotional decisions, lack of structure. When these are present, progress becomes almost impossible. But when they are removed, something changes. Trading becomes clearer, more controlled, more consistent. The deeper insight here is that success in trading is built on simplicity and discipline, not complexity. Professional traders are not doing something radically different. They are simply avoiding the mistakes that most traders repeatedly make. So the real question is not, what more do I need to learn? It is, what do I need to stop doing? Because once you answer that honestly, you unlock a completely different level of performance. So let's bring this to a close with one final perspective. Every trader goes through mistakes. That is part of the journey. There is no way to avoid them completely, but what separates those who succeed from those who don't is how those mistakes are handled. Now this is critical. Mistakes are only a problem if they are repeated. If you identify them, understand them, and correct them, they become stepping stones. But if they are ignored or justified, they become barriers. Professional traders are not perfect. They still make mistakes, but they do not make the same mistakes over and over again. That is the difference. So moving forward, the focus should be clear. Build a structured process. Eliminate the highest impact mistakes. Review consistently. Improve incrementally. And most importantly, take full responsibility for your decisions. Because trading is ultimately a reflection of your process and your behavior. If you refine those, the results will follow. If you found this valuable, make sure to like, comment, and share your biggest takeaway, and subscribe for more professional trading insights that will completely change the way you approach the markets.